The secret most Wall Street insiders won't tell you is that you can earn returns that feel like a lottery win while walking away from the biggest risks. What if the safest place you already trust could actually be your ticket to outsized gains? Imagine a portfolio that grows faster than a typical savings account. It never scares you awake at night. That's not a fantasy. It's built on 10 real, high-reward, low-risk strategies that actually exist. I'm going to break each one down, show you why they work, and reveal the hidden mechanics that turn ordinary money into extraordinary growth. First, let's set the stage. Most people think high reward means gambling on volatile stocks, while low risk belongs to government bonds that barely keep up with inflation. That binary thinking is the biggest obstacle to smarter investing. The truth is, the financial world is full of hybrid tools that blend the best of both worlds. They sit quietly in the shadows of headlines, waiting for a curious mind to uncover them. Over the next few minutes, we'll walk through 10 of those tools, from the ultra-secure to the cleverly engineered. By the end, you'll have a menu of options that can boost your net worth without the sleepless nights. Why does this matter right now? Inflation is still nibbling at purchasing power, and interest rates are dancing in a range that confuses many. Traditional savings accounts barely keep up, while the stock market's roller coaster feels unpredictable. In this environment, a balanced approach that captures upside while shielding downside is priceless. The options we'll explore each have a built-in safety net, government guarantees, proven corporate histories, or mathematical safeguards that keep the downside limited. Yet they also possess a growth engine that can outpace many conventional choices. Let's dive into the first pillar of the strategy: Treasury I-bonds. These are not your ordinary savings bonds. They are a hybrid of a traditional Treasury security and an inflation-adjusted component. When you buy an I-bond, the government locks in a fixed rate for the life of the bond, currently 0%, but adds a variable rate that adjusts every 6 months based on the consumer price index. In plain terms, the bond's value rises with inflation, guaranteeing you never lose purchasing power. Consider Jane, a 45-year-old teacher who wanted a safe place for her emergency fund but was terrified of the zero-interest label on most government bonds. She bought $10,000 of I-bonds in 2022. Over the next year, inflation surged to 7%, and the variable component of her bond jumped accordingly. By the end of the year, her $10,000 had grown to $10,700, a full 7% return, far outpacing the 0.5% she would have earned in a high-yield savings account. The magic is that the principal is fully backed by the U.S. Treasury, so there's no credit risk. Even if inflation were to dip, the fixed component guarantees a floor, albeit a low one. A surprising fact about I-bonds: they have a built-in tax advantage. The interest you earn is exempt from state and local taxes, and you can defer federal taxes until you cash them in. If you hold the bonds for 5 years, you can even claim the interest as a tax-free gift to a family member. That's a retention bump worth remembering. Most investors overlook this hidden tax shelter. Now you might wonder, what about the liquidity? I can't touch the money for a year, right? The answer is yes. You must hold I-bonds for at least 12 months, but you can redeem them after that without penalty, except for a 3-month interest loss if you cash out before 5 years. That penalty is modest compared to the potential upside, especially in a high inflation environment. Think of it like a short-term commitment to a high-quality relationship. Once you're past the honeymoon phase, you're free to leave with a smile. The second strategy builds on the same safety principle but adds a twist of corporate stability: dividend aristocrats. These are S&P 500 companies that have increased their dividend payouts for at least 25 consecutive years. The consistency of dividend growth is a powerful signal that the business is resilient, cash flow positive, and shareholder-friendly. Companies like Procter & Gamble, Johnson & Johnson, and Coca have weathered wars, recessions, and technological disruptions while still finding room to raise the cash they return to investors. Let's follow the story of Mike, a 30-year-old software engineer who wanted exposure to equities without the volatility that scares his risk-averse mother. He constructed a portfolio of 10 dividend aristocrats, each weighted equally. Over a 10-year span, the average annual total return, price appreciation plus dividend reinvestment, was about 11%, while the volatility measured by standard deviation was roughly half that of the broader S&P 500. The dividend component alone contributed an average of 3 to 4% annually, which he reinvested each quarter. That compounding effect turned a modest $5,000 investment into nearly $15,000, all while the underlying stocks rarely dropped more than 10% in any given year. Why does this matter? Because dividends act like a built-in safety net. If the market dips, the dividend cash flow cushions the loss, and you can even use it to buy more shares at lower prices. It's a classic buy low, add-on strategy that many seasoned investors swear by. Moreover, the tax treatment of qualified dividends is favorable. Most are taxed at the long-term capital gains rate, which is lower than ordinary income tax brackets for many filers. A retention bump here. The dividend aristocrat label isn't just a marketing gimmick. It's a rigorous standard enforced by S&P Dow Jones indices. Companies must meet strict criteria on market capitalization, liquidity, and dividend growth. If a company misses a dividend increase, it's removed from the list. This churn ensures that the list stays elite, and historically, the aristocrats have outperformed both the broader market and many high-growth stocks during downturns. The third tool in our arsenal is a tactical options strategy known as covered calls. At first glance, options might seem like a high-risk playground for speculators, but a covered call is the opposite, a conservative way to generate extra income on stocks you already own. The mechanics are simple. You own 100 shares of a stock, then you sell or write a call option against those shares. The buyer of the option pays you a premium for the right to purchase your shares at a predetermined strike price before expiration. Picture Sarah, a 55-year-old retiree who holds a diversified portfolio of blue-chip stocks worth $200,000. She wants to boost her monthly cash flow without selling any holdings. Every month, she writes covered calls on a portion of her portfolio at strike prices 5% above the current market price. The premiums she collects average $300 per contract. Over a year, that adds up to $3,600, essentially a 1.8% yield on her entire portfolio, on top of any dividends or price appreciation. Even if the stock rallies and the call is exercised, she sells at a modest premium above market, still realizing a profit. The risk is limited. If the stock skyrockets far beyond the strike price, she misses out on those extra gains because she's obligated to sell at the agreed price. However, the trade-off is the premium she keeps, which can be substantial in volatile markets. Think of it as renting out a spare room in your house. You earn extra income, but you give up the flexibility to use that space for a party. In most cases, the rent you collect outweighs the occasional inconvenience. A surprising fact: covered calls can actually reduce portfolio volatility. By consistently collecting premiums, you create a buffer that smooths out daily price swings. Studies have shown that a well-executed covered call strategy can lower a portfolio's beta by up to 0.2, meaning it moves less aggressively with the market. That's a retention bump worth noting for anyone who fears the market's mood swings. The fourth option is a less talked about but highly effective instrument: Treasury Inflation Protected Securities, or TIPS. While bonds already combine inflation protection with a fixed component, TIPS are straight-up Treasury bonds whose principal adjusts with inflation monthly. The interest rate is applied to the adjusted principal, so when inflation rises, you earn more interest on a larger base. Conversely, if deflation occurs, the principal can shrink, but you're still protected because the Treasury guarantees you'll receive at least the original principal at maturity. Consider a couple in their early 60s, Mark and Linda, who want to preserve their retirement nest egg's purchasing power. They allocate 20% of their fixed income allocation to TIPS with a 10-year maturity. Over the past decade, the average inflation rate hovered around 2.5%, and TIPS delivered a real return of about 0.5 to 1% above that benchmark. While the nominal yield appears modest, the inflation-adjusted return means their money kept pace with rising costs of healthcare, groceries, and travel, something a regular Treasury bond would have struggled to do. A retention bump. Many investors mistakenly think TIPS are only for inflation hedging, but they also serve as a diversification tool. Because TIPS react differently to monetary policy than nominal bonds, they can reduce overall portfolio risk. During periods of aggressive rate hikes, TIPS often hold up better than regular bonds, providing a smoother ride for the investor. The fifth high-reward, low-risk vehicle is a high-yield savings account or cash management account at an online bank. Yes, it sounds boring, but the numbers are compelling. In a recent year, some fintech platforms offered annual percentage yields of highs exceeding 4.5%, a figure that dwarfs the 0.5% you'd earn at a traditional brick-and-mortar bank. The FDIC insures deposits up to $250,000 per institution, making it virtually risk-free. Take the example of Alex, a freelance graphic designer who struggles with irregular cash flow. He keeps his operational cash in a high-yield account that compounds daily. Over 6 months, his $15,000 cash reserve grew to $15,340, an extra $340 that he could reinvest in his business or use as a buffer for slower months. The key is that the money remains liquid. He can withdraw at any time without penalty, unlike a certificate of deposit. A surprising fact: some high-yield accounts automatically sweep excess cash from your checking into a higher-interest money market sub-account, optimizing every dollar. This automation can turn idle balances into a steady income stream, essentially turning your everyday spending into an investment. The sixth strategy is investing in low-volatility exchange-traded funds ETFs. These funds select stocks with historically lower price swings, often from defensive sectors like utilities, consumer staples, and healthcare. The goal is to capture market upside while dampening the downside. One well-known example is the iShares Edge Skyman Vol USA ETF, which has consistently outperformed the broader market on a risk-adjusted basis. Imagine a retiree named Evelyn who wants exposure to equities but fears a market crash. She allocates a portion of her portfolio to a low-volatility ETF. Over a 10-year period, the ETF delivered an annualized return of 8%, with a standard deviation of 9% compared to the S&P 500's 15% standard deviation. The smoother ride meant Evelyn could stay invested during turbulent periods without the urge to sell at a loss. Moreover, the ETF's dividend yield adds another layer of income, reinforcing its high reward, low risk label. Retention bump. Low volatility ETFs often outperform during bear markets because they hold stocks that are less sensitive to economic cycles. Historically, during the 2008 financial crisis, low volatility funds fell about half as much as the S&P 500, preserving capital for investors who could stay the course. The seventh option is municipal bonds, especially those with high credit ratings and short to intermediate maturities. Municipal bonds are issued by states, cities, or counties to fund public projects, and the interest is often exempt from federal income tax and sometimes state tax if you live in the issuing state. For investors in higher tax brackets, the after-tax yield can be remarkably attractive. Consider the case of Priya, a software engineer earning $200,000 annually and filing in the 35% federal tax bracket. She purchases a 5-year municipal bond yielding 3% tax-free. The after-tax equivalent of that bond is roughly 4.6%, a solid return that beats many corporate bonds of similar credit quality. Because the bond is backed by the taxing authority's power to raise revenue, the default risk is low, especially for bonds with AA or AA ratings. A retention bump. Not all municipal bonds are created equal. General obligation bonds, backed by the issuer's taxing power, are safer than revenue bonds, which rely on specific project cash flows. Knowing the difference can turn a decent investment into a near risk-free one. The eighth high reward, low risk tool is a peer-to-peer P2P lending platform that offers low-risk loan portfolios. While P2P lending is often associated with high interest, high default loans, many platforms provide diversified, algorithm-driven portfolios that target borrowers with strong credit scores. The platforms spread your capital across dozens or hundreds of loans, reducing individual borrower risk. Take the example of Daniel, a 40-year-old accountant who wanted a fixed income alternative to bonds. He allocated $20,000 to a conservative P2P portfolio that only included borrowers with FICO scores above 750. Over a 12-month period, the portfolio generated a net return of 6.5% after fees, with a default rate under 1%. The platform's built-in reserve fund covered any losses, essentially acting like an insurance policy. A surprising fact, many P2P platforms now offer auto-invest features that adjust the risk profile in real time based on macroeconomic data. This dynamic rebalancing mimics professional fund management, giving everyday investors a taste of sophisticated risk mitigation. The ninth option is a dividend-focused index fund that tracks the S&P 500 dividend aristocrats. This is a hybrid of the earlier dividend aristocrat discussion, but packaged as a single fund, providing instant diversification and lower transaction costs. The fund automatically reinvests dividends, compounding growth over time. Consider Maya, a young professional who wants exposure to dividend growth without picking individual stocks. She invests $10,000 in a low-expense dividend-focused index fund. Over 15 years, the fund's annualized total return combining price appreciation and dividend reinvestment averages 10.5%. Because the fund holds only companies with a proven track record of raising dividends, the risk of a sudden payout cut is minimal. This stability translates into smoother portfolio growth, especially during market downturns. Retention bump. Dividend-focused index funds often have lower volatility than the broader market because the underlying companies are typically mature, cash-rich, and less sensitive to economic cycles. That means your investment can weather storms while still delivering robust returns. The 10th and final strategy is a short-duration bond ETF that focuses on high-quality corporate bonds with maturities under 3 years. Short-duration bonds are less sensitive to interest rate changes, which is crucial when central banks are hiking rates. By selecting issuers with strong balance sheets, think Fortune 500 companies with AA or AA ratings, you capture higher yields than treasuries while keeping credit risk low. Picture Ethan, a 28-year-old teacher who wants a stable income stream to fund a future home purchase. He puts $30,000 into a short-duration, high-quality corporate bond ETF that yields 4.2% annually. Over 3 years, the ETF's price volatility stays under 2%, and the income it generates can be used to cover part of his mortgage down payment savings. Because the bonds mature quickly, the fund can reinvest at higher rates if rates rise, maintaining its attractive yield. A surprising fact, short-duration bond ETFs often outperform longer-duration counterparts in rising rate environments because they can roll over maturing bonds at higher yields, while longer-duration bonds lock in lower rates and suffer price declines. This makes them an excellent low-risk choice when the interest rate outlook is uncertain. Now that we've walked through each of the 10 options, Treasury, I-bonds, dividend aristocrats, covered calls, tips, high-yield savings accounts, low-volatility ETFs, municipal bonds, peer-to-peer lending, dividend-focused index funds, and short-duration corporate bond ETFs, we can see a common thread. They all combine a solid safety foundation with a built-in growth engine, whether that's inflation protection, dividend compounding, option premiums, or tax advantages.